Decades ago, what's championed now as maximizing shareholder value was once synonymous with financial trickery. Back then, if a corporation funneled its own resources into boosting its stock price, it wasn't hailed as savvy business. It was condemned as misconduct, jail time for top brass, steep fines for companies, and the tarnishing of brand names were all very real outcomes. Fast forward to today, and the practice of companies buying back their own stock has become an everyday staple in American boardrooms. This move, now known as a buyback, pumps up stock prices, fattens executive compensation packages, and moves vast sums into shareholders' pockets, all without any true addition to the workforce or tangible innovation. How did this turnaround happen, where an act once seen as cheating would become a pillar of market strategy? The roots trace back to disaster. In the anything-goes 1920s, the stock exchange was wild territory. Executives meddled in their own share prices, insiders made quiet deals, and fortunes could appear or vanish overnight. After the catastrophic collapse of 1929, it was revealed that countless firms had been buying up their own shares to maintain the illusion of stability. When crisis struck, this illusion shattered and deepened the fallout. The following decade was grim. Mass unemployment, shuttered factories, collapsed banks. Faith in both Wall Street and market ideology evaporated. To restore some order, Roosevelt's administration pushed through sweeping reforms. One thing was clear: companies caught juicing their own share prices could expect to be prosecuted. For the next 50 years, such maneuvers were practically off-limits. Corporations funneled profitability into new research, expansion, and job creation, not artificial share inflation. Leadership meant building, not financial sleight of hand. And the health of the market mirrored genuine industrial productivity. That ethos started to shift in the 1970s as academic theories began to favor focusing strictly on shareholder returns. When U.S. economic policy turned toward deregulation under Reagan in the 1980s, these ideas took center stage. Corporations no longer felt compelled to channel profits into growth or people. They were encouraged to do whatever it took to lift share prices. A subtle regulation change in 1982, the birth of Rule 10b-18, was the game changer. With barely any scrutiny, it quietly protected corporations buying back their own stock as long as they played within flexible bounds. Overnight, a door was opened for practices that would have landed previous generations in court. From there, buybacks exploded. A minor tactic at first, they rapidly became corporate America's favorite lever. The sums ballooned from billions to trillions as the decades rolled on. Share count shrank, reported profits per share climbed, stock prices jumped, and executive bonuses soared, all without any new products, services, or jobs added to the real economy. This trend only intensified after the 2008 financial crisis. Firms that had been rescued with public money soon piled into buybacks, often with borrowed cash. Soon, buyback spending dwarfed investment in factories or R&D. The main beneficiaries? The richest slice of the population, who own the lion's share of corporate America. As this cycle deepened, the real economy suffered stagnant wages and faded job creation, while C-suite paydays broke record after record. Companies, instead of preparing for hard times or driving social progress, prioritized polished balance sheets. The tactic was so addictive that not just firms, but entire governments staked their reputations on high market indices, equating rising stocks with national prosperity. What once would have been considered reckless or even criminal is now the standard playbook. The private stagecraft of looking good on paper has edged out the hard work of actually generating new value. Throughout all of this, history's warnings are clear. Over-reliance on appearances breeds instability. Stock buybacks have become less about real capital or organizational strength and more about keeping up a facade. If there's any major risk, it's not simply a looming crash. It's confusing ever-rising prices with genuine economic progress. In the end, manipulation was once blocked for good reason. It weakens the foundation it rests on today. It's embedded in the structure itself. That's not innovation. It's a financial mask over erosion. The economy starts to orbit illusions instead of realities. If this perspective is new to you, keep exploring financial history because the secrets of stability and instability are often found in the lessons of the past.